Have you ever entered a trade and been frustrated by the fact that the stock just didn't move at all after entry, leaving your trading capital tied up in a trade that was going nowhere? I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our desk have tools available to them to make very big money in situations where stocks don't move at all, at the very same occasion where most traders are struggling and frustrated by the lack of movement of the stock. In this video, we're going to show you how you could have doubled your money on a trade using options on a stock that literally had no price change over a 6-month period. So if that sounds like something you'd like to learn how to do yourself, then stick around because I think you're going to be surprised just how easy this is. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so in last week's video, we talked about how Amazon, which had initially profited from the pandemic in 2020 up until about August of last year, and then just like that from September until the end of the year, Amazon just got stuck in that channel between 2,900 and 3,550. And last week, we taught you a technique for playing that range such that if the market were to stay inside that range, a very attractive return would be likely. Well, this week we're going to be covering a different and in some ways more powerful strategy to take advantage of a channeling situation, and it's known as the calendar spread. You'll also see it referred to as a time spread in some places, incidentally, but for the purposes of this video, we're just going to be calling it a calendar spread, and you'll see in a minute exactly why it's referred to as a calendar spread. Now, to understand what I'm about to teach you, you need to understand how stock options work, and I realize that most of you probably do know something about them, but just for a quick review, and this will be fast, so just hang in there if you already know how they work. What's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below the market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, on the put option, if the market goes way below the strike price of that put option, the buyer of that put has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closed below the strike price of the call, then unless the call was previously exercised, that call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. With that as background, let's go back again to December of 2020 on a day where Amazon was trading at 3,200, again inside that 2,900, 3,550 range where it had been trading for the previous 4 months. And so suppose that we went out 6 months to the options chain that expires on June 18th, which is almost exactly 6 months out. And we sell a call at 3,200 strike, and we also sell a put at that same strike price. And then we move out to the July 16th options expiration chain, which is about 30 days later, and we buy the 3,200 strike price call as well as buying the 3,200 put. Well, at that point, we have actually entered into what is known as an at-the-money call calendar spread and an at-the-money put calendar spread, with the short options, the one we sold, expiring in June, and the long options, the ones we bought, expiring in July. Now, before we explain just how powerful this calendar spread strategy can be, if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade, even if you're outright wrong on the direction, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Okay, so let's first take a deep dive into what has happened here so you can understand how this all works. And we'll start by focusing on the cash flow of the trade that we just made. And so let's start with the July calls that we bought, for which we paid $360.68. Now remember, each options contract represents 100 shares of stock, so you multiply that cost by 100 to arrive at a total cost of $36,068 for those. But simultaneously, you sell the same strike, that 3,200 call expiring in June, for $33,880. So we deduct that from the total cost. And it makes sense that you get more for the July calls than you'd receive for the June calls at the exact same price, because the markets has more time to move above 3,200, about a month more time with the Julys than with the Junes. So that if Amazon goes on a tear, the one selling those July calls has to build in enough premium to cover the loss he'd take by having to deliver Amazon shares at a much lower price than they're trading at. And so the call sellers in July realized that Amazon would have an extra month to push higher and higher, making their loss larger and larger. Whereas the June calls, well, those would be subject to that risk a month less than the Julys. And so naturally, they are priced less. And for pretty much that exact same reasoning, as you can see, we would have to pay more for the 3,200 put expiring in July than the one we received in cash for selling the 3,200 put expiring in June. Because again, the put seller is obligated to buy the Amazon puts at 3,200, even if they have sold off way below 3,200. And the July puts have an extra month of price movement risk than the Junes do, so naturally they're going to be more expensive also. So when you add it all up, it comes to a total cost of $4,246 to enter this trade, which is the maximum risk of the trade. Okay, so now here is the surprising part, because if we move forward to June 3rd, and this was set up intentionally to demonstrate the point I want to make in this video, you can see that Amazon literally is right back where we started at 3,200 after 6 months, with Amazon stock literally going nowhere. And so let's now take a look at what is going on with our trade. And as you can see, in the 6 months since we entered the trade, and with Amazon trading at literally exactly the same price as it was the day we entered the trade, there has been a dramatic drop in the prices of both the short June options and the long July options, with the June options both trading at around 55 and the July options both trading around 100. Now, it's crucial to understand why this is the case. You see, on June 3rd, the June 3,200 options are right at the money again, just like when the trade started. But now, instead of them being 6 months from expiring, they're down to 15 days from expiring. And so the market only has 15 days to make a move in one direction or the other, creating an obligation for the call buyers to either pay more for stock than it's worth if the market goes up, or in the case of the puts, be forced to pay more than the stock is worth if the stock sells off. But that can only go on for the next 15 days, and so naturally, the price of those options is much lower, because much less can happen in 15 days than it can in 6 months, like was the case when we first entered the trade. And the same is also true for the July options, but those are 43 days away from expiring on July 16th. And so while again the amount of time that they have to expire is a lot less than the original 6 months, 43 days is still a hell of a lot longer than 15 days. And so while those have dropped to about $100 each, they still have to retain much more price value than the June options that we sold, because the Julys have another full month before they expire, and the market has a full extra month to move even farther in any direction that it takes. And so both the July and June options have both lost value because of the passage of time, a principle which is known to options traders as time decay. And with the Junes so close to expiring, they have shed proportionately more value than the Julys have. So if we wanted to close the trade at this point and buy back the options we sold to close those options and sell the options we bought to cash those in, let's take a look at what the closing transaction would look like. Well, we'd receive $10,100 for selling the July calls, which still have some value in them. And similarly, we'll need to buy back what's left in the value of the June calls for $55.83. And in both cases, the prices were way less than they were originally, as we said. We'd also receive $99.10 for selling off the July put while paying out $55.63 for the June put to close that position. And finally, we need to deduct the original cost of the calendar trade, which, as we demonstrated before, was $42.46. And so when you do the math, you see that the final profit on the trade is $4,618, which constitutes a 108% return on the trade in less than 6 months. So what I'd like you to take away from today's video is that options income strategies like the type we trade on our desk here at SMB allow traders to make incredible returns, not on stocks that move, but on stocks that actually don't move. And that's not intuitively understood by most traders, but hopefully by now you do understand that there is this incredible value in simply the passage of time. So that if you know how to structure options trades like the guys on our desk do, you can easily take advantage of channeling or flat stocks like we did in this Amazon example and achieve really stellar returns in an environment where most traders would have struggled. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.